What is Days Sales Outstanding? Days Sales Outstanding, DSO, represents the average number of days a company takes to convert credit sales into cash, reflecting the time it takes to collect receivables. It is expressed in days and can be calculated for any period, monthly, quarterly, or annually. DSO is a critical element of a company's cash conversion cycle and is essential for assessing the liquidity of a firm's current assets. DSO is particularly valuable for evaluating a business's efficiency and the quality of its receivables. It indicates the amount of money tied up in debtors and the effectiveness of the collection process. A lower DSO signifies quicker conversion of sales into cash, indicating better cash management and operational efficiency. To compute DSO, you take the average accounts receivable during a specified period and divide it by the total credit sales for that period, then multiply by the number of days in the period. A DSO figure close to the credit terms offered to debtors can suggest a stringent credit policy. Since cash sales are excluded from this calculation, the focus remains solely on credit transactions. Interpreting DSO values provides insights into a firm's ability to convert receivables into cash. A high DSO indicates challenges in collecting payments, which may be less critical for larger firms with ample capital. However, smaller businesses often require faster collections to cover operational expenses. A low DSO reflects an efficient collection process, but overly strict credit policies could deter potential customers seeking more flexible terms. DSO serves several important functions. It helps gauge the liquidity of a business's current assets and assesses the effectiveness of the collections team. Additionally, it aids in financial modeling, forecasting, and understanding cash flow positions related to debtors. Analysts often utilize DSO as a trend indicator to compare liquidity over time and evaluate the acquisition value of a business, acting as an early warning signal for financial difficulties. However, DSO has its limitations. Without comparison to similar industry firms, it may lead to misinterpretation. DSO does not consider factors such as capital size or business model. Instead, it focuses solely on sales and collections. The absence of a universal DSO standard means that acceptable values can vary significantly across industries. It primarily assesses the credit component of total sales revenue, making it a less reliable liquidity indicator for firms with low credit sales. Furthermore, fluctuations in sales volumes can affect DSO interpretation. To improve DSO, companies should regularly monitor DSO levels and adjust their collection processes for optimal effectiveness. Emphasizing upfront cash payments and maintaining customer satisfaction can expedite cash collection. Firms should also avoid extending leniency to customers with poor credit histories and regularly review receivables. Offering multiple payment options and encouraging automated payments can facilitate faster collections. While no single ideal DSO exists, understanding an industry's dynamics and tracking changes over time can help businesses develop a suitable DSO benchmark.